In today's video, we are going to look at a survivorship policy. We're going to look at 3 different funding scenarios, a total of $1 million, $5 million, and then $10 million going into a survivorship policy, which is common numbers you will see when it comes to survivorship policies, as they are typically used for estate planning cases. However, if you're interested in cash value, they can be very attractive. As we covered in our last video, a survivorship policy is one policy on 2 individuals. The insurance company knows that there is a very high likelihood that they're not going to have to pay the death benefit out for a longer period of time, because both individuals have to die before that death benefit is paid out. So as a result of the insurance company being able to hold on to the death benefit claim for a longer period of time, internally, you will see reduced insurance expenses, which, if you're interested in high cash value, you will see a stronger internal rate of return there. So you can really look at a strong cash value policy, or you will see a strong cash value policy when looking at survivorship life insurance policies. However, there are some things to be aware of, such as the MEC treatment and how that is different. If you have not had a chance to look at our last video, I would check that out as we go through the details of exactly how that modified endowment contract works and how it is different when compared to a single life policy. So what we're going to look at here is a survivorship policy, but what we'll have a lot of fun with is when looking at the cash value growth. In my experience, what I have found is that different individuals like to examine that cash value growth in different ways. So for example, we can look at the annual internal rate of return, which will isolate what the cash value is growing by on a yearly basis. It's going to isolate the actual rate. So for example, if I am at $100,000 in year 1, I pay nothing in, and year 2, I'm at $105,000. What's my growth rate that year? The annual growth rate, isolating 1 year, 5%. So we'll look at the annual IRR, then the average internal rate of return, which will take into account all years. If I want to see what was my average IRR by year 10, 20, 30, we can look at it and see exactly what it is on a life insurance illustration based on the present dividend rate. Full disclaimer, you will see the actual performance adjust as the years pass. That's why it's so important to track actual performance. But we'll look at the annual IRR, average IRR, then the taxable equivalent. This is a fun one to look at. What are the 3 core benefits to a cash value life insurance policy? Safe, liquid, what's the third one? Tax-free. Tax-free if we do everything properly, such as not triggering a taxable event, a modified endowment contract being one of them. But if we do everything right and the cash value remains tax favorable, meaning we can access it tax-free, let me ask this. If you are in a 40% tax bracket and you can earn, let's say 4 to 5%, we'll say a 4% growth rate over here with a life insurance policy, based on your 40% tax bracket, how attractive is that 4% to you? Another way to think about this is if you were to put money in the market or somewhere else that could earn, let's say 7%, but you have to pay taxes on it, what would the effective rate be after you pay your taxes? It'd be lower than that 7%, wouldn't it? Yes, of course it would. So when we're able to look at life insurance and the tax favorable treatment, being able to access the cash value tax-free, that makes whatever the growth rate is more attractive to many individuals. So there are times where individuals like to see the taxable equivalent. Then we've got the yearly cash value growth for the individual that says, hey, the rate is great and all to see, but I just want to see the dollar amount I'm getting from the life insurance company each year. Show me that. And then also the total cash value gain, which simply means if I've paid in $10 million over 10 years, and by the 10th year, my cash value is 11 million, my total gain at that point in time is what? $1 million, because I've paid in 10 million and I have 11, that's $1 million more than what I've actually paid into the policy. So the total gain is just the dollar amount and specifically how much more I have than what I paid in. What we'll wrap up on wrap up with after we look at those different bullet points is the flexibility, because what I'll add about these funding scenarios is they're higher dollar amounts. Obviously, right? You've got 7 figures across the board. Let's take the $500K per year, and all of these examples will be over 10 years, which comes out to what? $500,000 per year. So when you hear funding a policy with $500,000 annually for 10 years, that's a large dollar amount. That may even come off as a large dollar amount to someone that has the means to fund a policy at that level. Typically, where that's the case is when an individual says, hey, I know I can fund that, but I don't know that I'm going to be able to fund it when my premium is due every single year. Is it possible to make the policy flexible? And the answer is yes. In the examples we're going to look at, in a case like this, the true minimum will be about $50,000 per year. They could pay that annually. They could even divide it by 12 and pay it monthly, and then add additional funds up to $500,000 per year. They don't have to pay in the full $500,000 every year either. Some years they might hit $250,000, then make up for lost time and hit $750,000. My point is, you can design a policy to be extremely flexible. This way, it doesn't feel like a burden, or I'm going to be obligated where I feel like I must get this money in. No, you don't have to do that. If you don't get it in, you will see lesser cash values and lesser death benefits. However, it's good to have that awareness up front, knowing that you're not committed, and if you don't get it in, everything's going to fall apart, which a lot of people feel like when it comes to life insurance. So let's have some fun and look at the numbers, shall we? So beginning with the $1 million option, we've got $1 million going into a policy over a period of 10 years. 1 million divided by 10 is a total of $100,000 per year. So here's our annual funding. This is for a couple, both age 60, similar to what we looked at in the last case study. At the end of the first year, we've got them at 61. 1 million per year. First year cash value, $83,500. Initial death benefit, $2.3 million. The death benefit is not paid out until both the husband and the wife pass in this particular example with this type of product. So first year cash value, $83,500. I paid in $100, which comes out to just about a 16.5% loss, meaning I have less than what I paid in, and the amount less than $100,000 is just about $16,500, which matches up with that internal rate of return. We've got the annual IRR, which again is going to isolate the growth each year, and then the average IRR. So looking at this, take a look at year 1 to 2. The beginning of, or the end of year 1, I'm at $83,531. I paid in $100 in year 2. In year 2, my cash value is $175. If you had $83,500 under your mattress and you added another $100,000 to your mattress, how much would you then have under your mattress? You'd have $183,531. We have less than that. It's $175 and change. Because we have less than what we paid in, that is why we have a negative annualized internal rate of return in year 2. When we look at year 3, we pay in $100,000. If we add 100 to 175, the year 2 value, we would be at 275. However, we're greater than 275. We're at 278 and change, which is where the 0.99% internal rate of return comes from. We're positive. So if we are in the red, what it means is we're getting less back than what we paid into the product. If we're in the black, that means we're getting our payment back and some. It's what we're receiving from the insurance company, again, isolating that year. So we see the annual internal rate of return over time. This is based on the present dividend interest rate, 5.75%. The IRRs are great to look at because they give us the net numbers. That's why I'm such a big fan of them. But there's the annualized IRR, and here's the average IRR. When's your break-even point? Break-even is when your cash value is equal to your total payments. Look at this, year 5. 500 in, 499 and change. You're just about there, but we're not there. That's why we see this negative internal rate of return of 0.05%. The next year, however, we paid in 600, we've got 617. There's your positive average internal rate of return. If we look at year 10, average IRR is just about 2.6. Year 20, when the couple is 80 years old, you're close to 4%, 3.92. Okay, so those are some different ways to look at the cash value growth, and you can look at IRRs and death benefit as well. But let's continue on here and look at the $5 million example. So same couple, considering a different dollar figure here, $500K per year for 10 years, still the 10-year funding scenario. If this was a single life policy, I'd look at it over 4 to 5 years, but you've got that different MEC treatment with the survivorship policy, and I want to make sure that term rider never becomes problematic. But what we're going to look at here is a couple things. One, you've got a higher death benefit. It's almost 5 times the size, and that has to do with the need for a higher MEC limit and larger funding amount, $500K per year. But look at this. The ratios are the same. What I mean when I say that is the individual paying in $100K per year and $500K per year. That policy is designed in an identical manner, meaning we're not saying you have to pay in a larger dollar amount in order for this to work. No, both of these designs have the minimum premium at 10%, a little bit less actually. But all things are equal from a design perspective, which results in similar cash value when we look at the ratios and such. It's almost identical, isn't it? You see it a little bit different as time passes. If you look at year 10, what's the difference? 0.01%. Not much of a difference, is there? No. But what do we have different over here? This is not the average IRR on the far right. This is the taxable equivalent based on a 40% tax bracket. So what this is representing is if I put my money into a taxable account and had to pay a tax rate of 40% on whatever those earnings were, I would need to earn, let's look at it this way, year 10, I would need to earn 6.55%, and then after tax, I would have a 3.93% internal rate of return or growth rate here. Same thing when it jumps, when I stop the funding, year 11, just about 8%, which means I'd have to earn 8%, and then after I factor in the 40% taxes, I'd be left over with 4.78%. And this is not assuming any management fees or anything like that. That is a nice report that some people like to see. I like to show it when one does request it. It's not always my favorite thing to look at because this is a 40% tax bracket based on income tax. What if we're looking at capital gains tax or something like that? Like there's different ways to look at that when we build out workbooks like this. Let's look at the 10 million over 10 years. So that's funding of $1 million per year. So here we go. Now the IRR, we don't have the IRR here. This is for the individual that just wants to see the growth in dollars. However, you can match this up. 1 million goes in, cash value is $835 and change. Look at the $100,000 example. 100,000 goes in, cash value is $83.5. Those are almost identical, aren't they? Just with another digit added there because it's a larger policy. What's that come out to from a percentage standpoint if you were to round up? Just about that 16.47. So you'll see consistency there across the board. Again, assuming everything is designed in an identical manner. So let's continue on here. What we've got now is as follows. When we look at the far right, what do you notice here? Total cash value gain. So what this displays is the total gain based on my total payment. So if we look at let's look at this guy here, year 6. You've paid in $6 million total here. You've got $6,182,000. So when we look at the gain column, we see $182,000. That represents all of the cash value above your payments. So I want to know specifically what's my total gain that I've received from the insurance company in this particular case. If we look at it in year 10, you've paid in how much? 10 million. You've got 11.5. That's a gain of 1.5 million and change. So it's a healthy gain there. The death benefit is north of $20 million in this example as well, which is very nice considering this is an estate tax planning move, which there's a lot more that goes into it than just a high death benefit. you do need to set this up properly if estate planning is your goal, with the right trust planning and such. But anyway, looking at year 20, there's the yearly cash value growth year over year. This is just isolating what was my cash value here at year 19. It was 17,469. The next year it was 18,277, which the growth there was $800,000. That's how much I grew by that particular year. And the total gain now, over 20 years, is $8.2 million. So we can convert that to a return and you'll see consistency with the IRRs and such, but it's really what do you prefer? And some people we work with say, hey, send me them all and I'll delete the ones I don't like. Some say, just show me the net dollar amount, like that's what I'm interested in. And then some prefer percentages. The thing is, we'll always design the policy for maximum cash value, make sure it accommodates the individual's goals, your goals in this particular case. But then if you like to get creative and see the additional reports, we can include those too. It's kind of fun checking that out. So the last thing we said we would look at is flexibility. So let's look at that $5 million example, which was the $500,000 per year for 10 years. And here's what we've got. So here's the actual illustration. And pretend for a moment that this is you. If you see this every single year, are you comfortable with it? Maybe. Depends on your financial situation. If you've got $5 million liquid, then yes, it's no problem. However, if you plan on cash flowing this policy and there's times you tie your cash flow up in real estate or somewhere else, knowing that you're not committed to this may go a long way. So what you are committed to with this particular design, or how we can design it with keeping everything the same, up here, we've got your base premium. Down here, we've got the cost of the term rider. What this couple is obligated to each year is the term cost plus the base premium. Now, if I start out with just the minimum and add less in the PUAs in day one, that term cost will be slightly higher. And the reason why is because when you dump money into PUAs, we always think cash value, but PUAs also buy you additional whole life death benefit. And how this term rider works is as you add money to the policy, your whole life death benefit goes up and your term comes down. Here's an easy way to illustrate. Day zero, you're at almost 9.7 million. At the end of the first year, it was 9.7. Now it's about 8.7. What's resulting in that decrease of almost $1 million in term insurance is a result of those PUA payments here, because there's a heavy PUA payment made to the policy that pushes up your whole life death benefit. Very mechanical explanation there as far as how the policy works and such. But my point is, we see the term shrinking very quickly in this example. So if we're not dumping in a lot of funds into PUAs, the term will not shrink as quickly. So as a result, the term cost is higher there. So with all that said, the minimum here in this example would be about 50K when we add those two and round up a bit. So this individual, this is what a lot of people will do, can set it up where they're billed for $50,000 per year, and then all additional PUAs they could throw into the policy on an unscheduled basis. Unscheduled means they add them or you add them when you want to add them. Not billed for it. You've got flexibility. You can set up auto payment through the online portal. Very, very nice feature. So that's the 500K per year. You'll see the exact same thing when we look at the 1 million per year sample. There you go. Same thing with that minimum premium. Where that oddball number is coming from, by the way, look at the PUA amount. It's 10x what the base premium is. It's the maximum we can illustrate going into the policy each year. And this is a company limitation with the exception of the first year where we can illustrate up to 50x. But we'd have to add a lot more term to prevent the MEC in that case. We've got other videos that go through that. Anyway, I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have any questions at all, please feel free to leave them below in the comment section or reach out to us. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.